Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, February 12th. Powell held his ground yesterday in Congress, resisting pressure for lower interest rates. The market reaction was quite muted. Now, all eyes are on today's US inflation update and its impact on Fed policy and stock valuations, while the rally in Chinese technology giants gathers steam, with big names like Alibaba and BYD driving fresh inflows on AI bets. So Jerome Powell's testimony yesterday went quite smoothly. He said that their policy stance is now significantly less restrictive than it had been, and that the US economy is remaining strong, and that they do not need to be in a hurry to adjust their policy stance. So that was pretty much in line with his previous remarks after the latest rate decision of the Federal Reserve, when the policymakers there had made the decision not to further cut the interest rates in the US, remember? So Powell also didn't want to get too political with the Congress yesterday. He actually said that it is not the Federal Reserve's job to comment on the tariff policy, and that the impact of these Trump tariffs are, well, quite unknown, but could eventually increase the inflationary pressures in the US, as he said, someone will have to pay for them. Again, that was very polite, but when you add 25% tariffs on your metal imports, for example, well, you generally boost inflation. So that's it, really. The markets didn't give a crazy reaction to Powell's testimony yesterday. The US yields actually rose slightly, but the US dollar index gave back gains and tested the 50-day moving average to the downside. In the equity space, the Dow Jones Industrial Index advanced 0.30%. The S&P 500 was quite flat, while the Nasdaq 100 index slightly retreated. Now all eyes are on today's US inflation update and the US 10-year bond auction. Now the US headline inflation is expected to have steadied near the 2.9% level in January. Core inflation may have eased from 3.2 to 3.1% year on year. And a set of softer than expected inflation numbers could help soothe the inflation worries in the US and encourage a deeper retreat in the US dollar and a further advance across the major peers. While, on the other hand, a stronger than expected set of inflation figures from the US today could further fuel the inflationary worries, back a further rise in the US yields and the US dollar, and also weigh on risk appetite at a time when the big technology earnings actually fail to give a much needed boost to these market valuations. Except for Meta, of course, because Meta is doing quite fine these days on its ability to transform AI spending to improved revenue, but the rest of the Magnificent Seven stocks may be running out of steam. Now, for those who are actually looking for alternatives to big technology companies of the US, well, the Chinese technology stocks are, well, quite in demand these days, nicely surfing on the DeepSeek wave. Alibaba, for example, gained more than 40% since the middle of January, while Warren Buffett-backed BYD, Build Your Dreams, rallied more than 7.5% today in Hong Kong and is also up by a hefty 42% since a month. The news that the company BYD plans to integrate software from DeepSeek in its cars, and also their announcement that they will offer God's Eye, which is simply their driver assistance system in China for free, will help boosting the outlook for, well, the Chinese EV giant sales and narrow the gap with Tesla, which, on the other hand, is, well, quickly falling from grace these days on slowing sales of the electric cars. That's not only due to the slowing global appetite for these electric vehicles, but also, unfortunately, also due to Elon Musk's involvement in world politics, openly supporting the far-right leaders in Europe as well, for example, who are not necessarily the favorite candidates of the people who choose to go electric for their cars. But anyway, Overall, the stocks in Hong Kong, while they did not look this promising in a while, and there is actually a substantial room to extend gains before retesting the 2018 and 2021 piece. So that was, remember, the time China actually declared war against the Chinese technology champions, and okay, things went so bad after that that I would hardly actually believe that the Chinese government would do the same mistake again, but you never know. But still, before we move further, the Chinese technology giants have two key advantages. One, they have big technology names that have a proven track record for building game-changing technologies. And now I'm talking of the companies like Alibaba and Tencent, for example. And two, well, Chinese consumers tend to be easier to convince and more eager to adopt new technologies, allowing these technology advances to spread faster. So yes, ladies and gentlemen, if you are looking to spread your AI bets to beyond the Western names, the Chinese big technology companies do look promising despite the technology and the trade war, and even despite the government risks. In Europe, well, equity markets are performing well too as the convergence trade with the US continues to build up. Now, oil and energy stocks in Europe have been leading gains lately, and that despite Donald Trump's tariff threats, and the EU leaders pledged to answer with tariffs on their own. Also, on the headlines yesterday was the US Vice President J.D. Vance warnings regarding over-regulation on AI and over-regulation on US technology companies from Europe, and Ursula von der Leyen's pitiful response to an aggressive speech that we heard while here in Europe from Mr. Vance, where she only smiled and said that, well, she actually liked the part of the speech when Mr. Vance was saying that Europe, well, should be more optimistic regarding the new technologies and not only fearful regarding AI especially. But having watched a few moments from that speech, the European leaders, including Ursula von der Leyen and Emmanuel Macron, well, they looked quite concerned and they look like they're not liking the speech much. But anyway, the EU Commission chief could at least spit out a timid, we would like to be optimistic about the transatlantic trade relations as well, but we are obviously far, far from a full blast retaliation from the European countries for now, which is a good thing, by the way. In energy, US crude rallied past the 50-day moving average and rebounded lower after touching the $73.70 per barrel level yesterday. The sight of a more than 9 million barrel build in US inventories last week, suggested by yesterday's API report, somehow killed joy among the oil bulls. So the freshly breached 50-day moving average level could eventually act as a short-term support for a further extension of these gains in the short run. But I expect to see a strong resistance approaching the $74.50 per barrel mark, which is near the 200-day moving average and also around the major 38.2% Fibonacci retracement on the latest sell-off in crude prices, as I believe that the global economic outlook is not looking particularly promising, with the tariff threats flying in the air here and there to call for an easy rally above this technical resistance. Elsewhere in the energy, the European natural gas futures are extended their gains on melting gas reserves in Europe, and also on the fear that the upcoming cold days in Europe will further draw down these reserves, while the US natural gas futures successfully held ground near a key Fibonacci support level, and they actually do remain upbeat as well. In the individual space, BP, remember, which had gained more than 7% on news that Elliott Investment Management would step in to tidy things up, lost a meager 0.62% yesterday after announcing that their income dropped 35% during the course of last quarter due to lower oil and gas prices and also lower profits from its refineries. Now, if you want to invest here, I think that 430, 445p range could be an interesting entry range for investors who would like to. I'll take this chance on Elliot's plans to shift the company's focus from renewable to traditional energy sources and boost revenue, given that the ESG and climate-friendly investing will be out of the window for the next few years. And oh, if you haven't heard that news yet, well, the same Elliott also disclosed more than $2.5 billion worth of a stake in Phillips 66 yesterday, and the company's share price jumped nearly 5% on the plans to a potential spin-off and sales of its pipeline business. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.